Hi, welcome. You're watching MF Corner. I'd now like to invite Mohit Gang, CEO and co-founder of Moneyfront, to talk about some of the issues that DIY investors are facing. Hi, Mohit. Thanks very much for joining in. So, somebody on Twitter actually just reached out to me saying that they were on one of these new fintech platforms, and they were surprised that they were being offered only regular plans, for mutual funds and not the direct plans, which is which is the whole objective of direct plan, right? Is for DIY investors. So how can investors know before they actually make the commitment whether they're getting into regular plans or direct plans?
Hi, Sumaira. Good afternoon. It's always a pleasure to be on your show. So look, I think as you rightly pointed out, DIY investing is when an investor himself or herself wants to go out on a digital platform and do things or handle her investments by themselves. Basically, they want to take complete control. And typically, the benefit of such a thing is that it offers an seamless execution, right from evaluating the schemes to execution to monitoring, basically. Now, the point which you brought out is very, very relevant. If your platform is only offering you regular plans, then the whole objective of going digital and not going through a distributor or an intermediary kind of gets defeated. There could be other benefits though, and we can argue about it. But the prime objective is to be able to invest in direct plans. Now, how could one distinguish between whether a platform is offering you regular plans or direct plans? Number one, and very, very simple, every scheme which you buy, which is a direct plan, will have the word direct in it. It's a very categorical requirement from SEBI that scheme which is direct plan will have to carry the word direct. Unlike the regular plan schemes will not have any word. So let's say, just for an example's sake, if it's a fund called, let's say, HDFC Equity Fund or HDFC Flexi Cap Fund, in regular plan, the name will be HDFC Flexi Cap Fund Growth Option, but in direct plans, the name will be HDFC Flexi Cap Fund Direct Plan Growth Option. So you will have a very clear understanding just from the name itself. That's the most important part. The second important way of looking at it is you check the expense ratio of the scheme. So most of these platforms will also show you the expense ratio of the scheme. If you can figure out, and you can go to an independent third-party website or the fund house's fact sheet or website and check the expense ratio, a direct plan expense ratio will always be much lesser than the regular plan expense ratio. And that's the second way of tracking it. And the third way, which is a slightly more cumbersome way, is to check whether the platform has a SEBI RIA license or a SEBI registration number, basically, which is like INA or INZ, a 12 character kind of an alphanumeric key. So they are supposed to be, or they are actually, these platforms which carry a SEBI RIA license can sell direct plans of mutual funds. Unlike a platform which carries an MFI ARN only, and they don't have a SEBI advisory license, then they're not supposed to be selling direct plans. They can only give you distribution services. And typically those platforms with ARN number or those banks with ARN number will only offer you regular plans. So these are few differences if one could be careful about it.
Okay, so this is a very important thing, and I didn't know this distinction as well between who can offer regular plans and who cannot. So glad to have that clarified. But Mohit, there's a lot of also subconscious messaging that's goading investors to take riskier bets than they would have liked to. So how do DI investors sidestep it when it's a unconscious or subconscious decision, right, that they're making? So how do they knowingly sidestep it?
Look, so I think there are both pros and cons of technology, Sumaira. I think technology gives you that ability to execute swiftly, on the go, research, monitor, do a consolidated reporting, which are many advantages. And that's the reason why a horde of investors are moving towards DIY platform. It's quite quick, easy, seamless. And within fraction of a minute, you can actually go ahead and execute your transactions. And compare that to the old era when you had to actually sit back and fill forms, cut out checks and do all those manual works. And one error could have actually resulted in a loss of resulted in huge compensation, or could have resulted in a loss of value for you, right? So those advantages are intrinsic, but as you rightly said, those nudges and those soft push which comes with a digital platform, one has to be very, very careful. Now, my 2 bits on that is that try and see whether your platform is offering you everything free of cost, or are they really charging you something. Look, there are no free lunches in financial world, Sumaira, and let's be very honest about it. Even we run a platform, and we have to survive for our sake, basically. So we have to charge our clients a fee or a money or some portion of, as you call it, you might call it advisory fee or you might call it platform fee. There could be different nomenclatures for it. But if the platform is charging something, that means they have a revenue model. But if they're not charging you something, they're giving you absolutely everything free, and they're giving you direct plans also, which means there has to be some other ways and means how the platform is making money. So in that cases, in those particular specific cases, your radar has to actually go up for an investor and try and be more cautious when you are trading in those platforms, basically. And then you have to be a little beware of those soft nudges. So they will keep flashing new NFOs, new IPOs, new offers, funds being sorted just on last 1 year returns. These are all red flags to me, honestly. If you get a lot many nudges around these, if you get a lot many push items or mail communications around these kind of things, then you have to be aware. One or two is fine. Telling you about what is on offer is fine, but giving you soft nudges and invoking that greed and fear hypothesis to make you purchase something can really be harmful for an investor in long run. So my whole thing is you have to be very careful whether a platform has some revenue model, and plus are they giving you too many nudges around NFOs and few of these latest offerings that typically shows that one is more keen on building AUM and not going by the right process for investments for a particular client and his suitability.
Yeah, eventually, it doesn't matter which show I do, what is the topic of the show, the end result that it boils down to is buyer beware, right? Everything comes down to that in the end. Okay, anything else that DIY investors should watch out for?
Yeah, look, Sumera, I think some of the basic ground rules of this thing is, and I personally feel that one has to keep his investing and trading pot separate. I've of late been seeing many DIY investing platforms providing trading and broking services also. To my mind, it kind of gives you consolidated reporting, but if you keep the reporting aside, the more harmful part is that investors are then given those soft nudges and pushes, basically where they are more focused on short-term trading and trading strategies. And I've seen many investors actually redeeming from their long-term investment corpuses and trying and moving into short-term stock ideas or taking trading calls or actually moving into derivatives, which can be very harmful for investors in the long run. Look, we have to also understand that most of the audience which is coming on these DIY and digital platforms is the new age millennial audience. They have not actually seen many corrections in their investing life. And these kind of nudges or these kind of digital push actually can lead them to defocus from investing or long-term investing approach and focus more towards the short-term trading strategies. So my two bits out there is to keep your trading and investing separate, keep them as two different accounts if that's possible, and beware of that part. The last part, I think, which is very critical, is to make sure that your platform has a physical channel to speak to. They have some advisors, they have some service channels, because there are a lot many non-financial transactions like change of nomination, change of bank mandates, change of addresses, KYC updations, and all those things. And I see less and less platforms focusing on these minor nuts and bolts. They actually are more keen on giving 2-click, 3-click investing to investors and not focusing on verifying the credentials and making sure that the records are proper with fund houses. So you have to verify that all your records are clearly and updated with all the fund houses in proper manner. And you have to make sure that there is some support channel. There is an RM or an advisor or a service support where you can speak, take ideas about investments, discuss your own portfolio plans. Every individual is unique. And last mile customization is not possible with DIY platforms. But what is possible is that if your platform provides you an RM channel or an advisory channel, then you need to talk to them and take help in building your portfolios. That help might not be very frequent, but if they give you that help, then yes, I think DIY by all means is a better way to invest, because finally they will offer you direct plans and they will give you ease of investing and reporting everything together.
All right, Mohit, thanks very much for once again, highlighting an important issue and an issue that DIY investors, the ones who actually need this kind of support the most, could benefit from. So that's about all we have on MF Corner today. But do remember to email us your queries and we will have it answered through the week with experts. Do stay tuned in. Closing bell will take you through the last hour of trade.